Today's episode is brought to you by Scientist.com, the life science industry's leading R&D orchestration platform. Scientist.com gives researchers instant access to thousands of pre-vetted suppliers, saving time, reducing costs, and accelerating innovation.
Hi, I'm John Gagliano, Senior Director of Biopharm Catalyst.
Hello, I'm Sheff, known as Sheff Station, a 20-year vet in trading biotech stocks.
And this is Biotech Bulls and Breakthroughs. Biopharm Catalyst is not a registered investment advisory firm, and the views on this podcast are not intended to be financial advice. Guests on this podcast may hold the stocks discussed in personal or other investment accounts. This content is for informational purposes only and should not be considered investment advice. Always do your own research before making any investment decisions. Good morning, good afternoon, good evening, depending on when and where you're joining us from. Welcome once again to another episode of Biotech Bulls and Breakthroughs. Today is February 18th, 2026, and we are back for our monthly podcast episode with none other than Sheff. Sheff, welcome back as always. Hope everything's been going well for you.
Been going great. It's
Yeah.
been going great. This market is it's full of surprises, good and bad.
Yeah,
I love it. More good though.
Absolutely. We're going to touch a little bit on just some of the kind of high level market stuff, but as always, we'll spend a bulk of the time on the catalyst. And just for folks who are listening in today, one of the things that I think we're going to dive into, which we've done in the past, but we're going to do a little bit more this episode, is tying in some of the cash positions that some of these companies have. So Sheff is going to talk through a little bit on, how cash plays into, his thinking and how it's impacted some of the plays in the past, and just mention the cash runway for a lot of these positions. I know it's something we've mentioned, and if you're, a veteran biotech investor, you certainly know a lot of these companies are pre-earnings, right? Cash matters a great deal in terms of how much runway they have left to be able to operate. It's something that we track at Biopharm Catalyst. And it's something that you can see on our FDA calendar. You can actually see separately on our separate cash database, and something that is, frankly, something that we're really passionate about tracking because we know how much it matters. And for those of you who don't know, what we actually do is intra-quarter, before the filings are actually submitted, we will take press releases and news that has come out and sort of estimate the live cash position, so you don't have to wait until the end of the quarter to find out, roughly how much cash a company has, and how quickly the company is going through that cash position. So I think it's a pretty unique thing we do based off of the news that we receive, and I just wanted to mention that. And I know Sheff uses that data pretty actively. Correct me if I'm wrong there, Sheff.
Yeah, it works out really well. It's the cash position just tells you how healthy the company is and how much they depend on one product or their whole portfolio. And so it really allows an investor the chance to look at it as either an investment for just a catalyst for, say, a quarter, or whether they want to take a 1 or 2 year position on that catalyst. It really helps out quite a bit.
Yeah, absolutely. So yeah, we'll definitely touch on that. Another thing I wanted to mention is that we actually released our hedge fund data today as well. We track some of the top hedge funds that invest in biotech, and each quarter we update their positions. We track what their current positions are, what they're trading in, and how that changed from last quarter. That information was released today, so you can find that on our website under BPC reporting. Like I said, it's something we do each quarter, and I know it's heavily used by a lot of folks, so I wanted to mention that. Just jumping in, I mean, Sheff, obviously, been a great, last 6 months, last year in biotech. We're seeing XBI well north of 120, right? The last month has been a little bit flat, but S&P 500 has been more or less flat since, beginning of the year. But overall, I would say, obviously been a really, really good year in biotech. We saw Eli Lilly cross the $1 trillion market cap threshold,
Wow.
which is crazy, right?
Yeah, that's
Yeah,
insane.
absolutely. Clearly with some of the the weight loss initiatives that they have, as well as the acquisition. I know they also have an acquisition with Orna Therapeutics that they announced as well. So a lot of stuff happening in the markets with respect to that. Obviously, um, we've seen a little bit of M&A. I think M&A is going to continue to be driven by some of these patent cliffs that are coming up in the next 2 or 3 months, right? And as companies are looking to backfill some of these pipelines, those companies are going to certainly be ripe for M&A. So obviously, quite a bit going on in the markets, but just wanted to get a sense for how you're feeling about things. Over the course of the last month, anything that you feel is really pertinent for the listeners.
Well, and the other thing that's really playing a part in what we're seeing in terms of M&A activity is the space. And so a lot of these rare disease space companies um, that are smaller to mid cap, but you're talking about large cap companies trying to fill fill their pipeline. They're looking to these smaller companies, and a lot of these companies have platform type science pipelines that are going to significantly enhance a large cap company. And so I think a lot of what we saw in terms of merger wise wasn't necessarily around JP Morgan in the first half of the year. I think, we're going to start seeing those companies that look to get bought out in the latter part of the first quarter and into the second quarter as data starts to mature and develop. But one thing I did notice about these companies that are getting bought out is that they all have healthy balance sheets. And I think that's the key for any of these larger companies that are looking to, looking to purchase, like Eli Lilly, purchase the private company. And then you have Pfizer, you have AstraZeneca, you have Gilead, you have AbbVie, you have companies that are really in this obesity market space. And it's going to continue to change. It's going to continue to grow. But
Yeah.
I think there's going to be fewer and fewer players as the big companies start to really look at companies that are further along in the process. Um, and it's going to tighten that marketplace right there.
The FDA had announced its sort of the pre-check pilot program, like aimed to essentially try to move some of the manufacturing domestically. I think we had touched on this in a previous podcast, if I'm not mistaken. But that it'll be interesting to see how that sort of affects the drug manufacturing and sort of the supply chain ultimately for how these drugs are manufactured.
Absolutely. Absolutely. And I was mentioning too in terms of just the space, in terms of the first half of the year, the obesity space, which was hot last year. There's going to be a lot of changes this year, and a lot of it's going to come to the readouts and different events in the first half of 2026. You know, if Lilly lowers the price of their orforglipron to match or undercut Novartis's Wegovy pill. There could be concerns about whether Lilly can make their 22 or 2026 guidance. And if obesity drug prices are deteriorating faster than anticipated, that's going to affect the market as well. So I think a lot of things are going to be coming into play in 2026. Pfizer and Amgen and others are going to try to enter the obesity market with lower prices. There could be a downside to the risk as well as street expectations of this, $150 billion market for obesity drugs. So the other thing that's going to be interesting that's going to affect, I think, is compounded obesity drugs could continue to be a headwind to branded drug growth for a lot of these
Mhm.
larger companies. So, if you start getting compounded drugs in there, then obviously that's going to cut into revenue, and larger companies are going to have to take a look at how they proceed to capitalize on the growth in the market. There's going to be readouts from new drugs from Pfizer and AstraZeneca at the ADA, American Diabetes Association, that could drive the street to rethink again who comes out on top in this marketplace. We talked about M&A. M&A is going to continue to reshape the environment with companies that are still interested to expand or get into the space, and companies deprioritizing assets like Gilead. And then finally, I think the final two things: companies are getting creative about how to expand their obesity franchises. By looking at obesity plus, cholesterol lowering drugs like Regeneron, taking one drug and seeing how they work in two different disease entities. AbbVie is doing that as well. They're using obesity drugs with aesthetic drugs. As you lose weight, how can you increase your presentation with aesthetics? And so Gilead's looking at different combinations there. And then finally, the thing that is really important is the size of the international market. It's huge, but it's still to be determined, especially in China, where domestic drugs may take the lead. And so,
Yeah,
that's going to be huge right there.
absolutely.
So it will
I
be
couldn't agree
interesting.
more. And I mean, yeah, who knows the sort of the where the ceiling really is on this on some of these weight loss drugs. I mean, just anecdotally, there's a fair amount of people that I know that take them, and just across the board you're just seeing they're growing and growing and growing in popularity. And to your point, companies are figuring out different ways to combine them with other targeting two indications at once, as you had mentioned. And it's going to be interesting to see how that unfolds. Clearly, this is not just sort of like a fad. This is something that is here to stay, and likely going to um, be built off of moving forward. So
I was just going to say the other thing too is Merck management has stated that in their view, orals are going to be a better route than injectables moving forward. So I think the delivery of these drugs is going to be extremely important moving forward.
if you find the information that Sheff is presenting on this podcast useful and would like to gain more insights into his trading strategy for individual tickers, you can donate to this charity, the Northwest Association for Blind Athletes, and all individuals donating $300 or more get full access to his VIP private X account. Founded in 2007, the Northwest Association for Blind Athletes is a national leader dedicated to improving the quality of life for children, youth, and adults through participation in sports and physical activity in communities across Washington, Oregon, Idaho, and Montana. NWABA's programs focus on helping people who are blind build confidence, gain self-esteem, develop friendships, and reach their greatest potential. You can donate by clicking on the link at the bottom of our podcast page, www.biofarmcatalyst.com/podcast, or via the link in the YouTube video description. Cool. Well, yeah, definitely a lot going on in the in the market, Sheff. Let's jump over to discussing your Catalyst watch list and some of the things that you're keeping an eye on in the next over the course of the next several months. So, do you want to kick it off with your ideas and talk through some of those along with the cash positions as we had mentioned?
Absolutely. And I think that's one of the things that is so valuable, and I think is really helpful with the tool on Biofarm Catalyst, that I'm definitely going to be, as you spoke of, implementing more in terms of just discussing this cash position, because oftentimes what we're seeing is cash has definitely a definitive effect on if an event is not positive, how far it falls. So there's a lot of risk reward associated with the results of a clinical trial and the cash position that company has. And what I want to do before we get started in the catalyst is I want to go over a few catalysts that I touched upon in the prior call.
Yep.
And one was QNCX. So QNCX is Quince Pharmaceutical, and they had a study that where basically they were able to tease out 6 to 9-year-olds in ataxia galactasia, and because their phase 3, the the whole overall trial failed, the portion of the 6 to 9 shows statistical significance. So when they did their second study, there was a lot of thought that that study would be positive. Well, it wasn't. It failed. And when it failed, you looked at, okay, that was basically the main product that they had. They had that, and then they had the device combination. So when they failed, they were pretty much left with nothing but their cash position, which was low. And so right now, that stock had a historic fall. It literally fell. From 325, 330 down to 30 cents. Now it's down to 18 cents. And then subsequently, last week, they talked about the fact that they were going to put in measures to increase shareholder value. And shareholders got excited about that because they thought, okay, if they're going to maximize shareholder value, either they're going to sell off the remaining assets into a shell or they're going to, another company's going to buy them. Anyway, all that to say, the stock went to 85, 90 cents. So it was up 5 times what it's at now. And then within 2 days, it subsequently fell back under 20 cents. The reason I mention that is because the cash position was not extremely strong. So the risk was if that trial failed, that the company would be in the position that it's in now, which it did. And so it wasn't a good stock to play through data. There's rarely any stock that I ever play through data. And actually that day, when the data came out, they released the data 1 hour before market close, which is typically not what a company does. Usually they share the data pre-market or they share the data post-market. So that was leveraging too much on a play, not respecting the risk reward in association with the cash position, and then really moving forward, focusing on the entire pipeline along with the cash position. So that one did not do well at all. And there's 2 other ones that I want to talk about that one had poor phase 3 data, but because there were so many institutions in it, and they had such a strong cash position that the company subsequently bounced back within a month's time. That is Resolute, ticker symbol RZLT. Now, RZLT was about $13 or $14 a share. That was one that I didn't have, but I didn't own a ton of. I owned a really small position because of the risk associated with the phase 3 study. But it goes to my theory in that when that stock prior to data, it was $14, $15 a share. But they had $121 million in cash, as you can see on the screen. They had 17 months of cash, almost 18 months. And so when that stock had poor phase 3 data, it fell down to 80 cents. So if you have investors that aren't willing to hold into a phase 3 catalyst and they see an opportunity like this on a failed phase 3, they look at the cash position and know that at 80 cents, that company is trading well below cash, and there's a lot of institutional investors in the stock, as there was. It was also one of Guggenheim's top picks. So within a month and a half, that stock went from 80 cents on the low from that phase 3 data in December to where it's at now, which is basically 2 months later. It's up, over 300%. So to 362. And that has a lot in part to do with the cash position in the company of having $121 million in cash. They have top line data in the second half of 2026, but it's just a good way for investors, again, to look at the risk reward associated with, not only data points, but if the data is bad, getting in at the bottom of a stock off of that bad data. And with the cash position that they had, it bounced back nicely. So I'm going to touch on 2 more really quick that didn't have good cash positions, and they were INDs and didn't do well. And it's another lesson in knowing the cash position of the company as you're holding into a catalyst or as you're trading up to that catalyst before you're selling, and knowing the risk reward associated. So I'm going to go over 2. Gary, Tom, Boy, Paul, and that's GT Biopharma. They had an IND that, the stock was trading around 80, 90 cents. And what happened is the stock was on fumes. So the IND was expected in the first half of January. And right before the IND acceptance, the company didn't make it through the catalyst. And so they ended up selling shares the day before, dropped the stock, literally from, the mid 70s down to 40 cents. And then the next day after they raised, they had the submission, they had the acceptance from the FDA on their IND, which is totally counterintuitive. You would most of the time share the catalyst and then you would raise. But because the company was low in cash, they ended up doing the opposite. So the reason that's important is the company had extremely low cash position. They had to raise, and the stock never had a chance to hold its gains after a positive catalyst because they were low in cash. So that was the first one. The second example was so it's GTBT, FBLG, Frank Boy Larry Gary. And that's another one that was trading, it traded as high as, 40, 45 cents. But as it got closer to the catalyst, they had a low cash position. And, they ended up, after the catalyst, ended up trading slightly higher and then it fell. And the company is going to raise money, but then they also had a threat with a reverse split vote that's supposed to take place next week. And so reverse split votes with biotechs, investors do not like that. So that's another one where the risk was higher than the reward. And because of two things, the reverse split vote that people knew that was going to happen on the 19th, and then the fact that they had a low cash position going into their catalyst. So the reason I mention that is that moving forward, as I talk about the catalyst, I'm going to touch upon the cash position. And that'll give you an example of how good a stock can do in terms of their cash position. And then oftentimes with cash position, there's a lot of ownership involved as well. But let's start out. ACRV, Acrivon. So ACRV has data that they're going to be presenting at the ESGO meeting in Copenhagen, Denmark. It's the ESGO meeting, February 26th through the 28th. And it's important to know that that stock is $1.59, but they have $110 million in cash, which is significant for a small cap company. So they literally have 27 months of cash. You have a solid catalyst here to trade into. Obviously, you have another week or so to the catalyst, but it's phase one data as well. So phase one data is often, if I'm going to trade around data, it's usually going to be phase one or phase two data, because most of the time those data don't have hard clinical endpoints in terms of statistical significance. Oftentimes it's fact finding for biomarkers, pharmacokinetics, and other things that can oftentimes lead to solid appreciation prices upon data. So that is a 26th to the 28th. That's a solid catalyst in February. And again, this company is dedicated to precision cancer medicine. So that's one I'm watching. I don't own it, but I'm watching it. A key data point for February is in GOSS, GOSS. They have phase 3 data in February. They're going to have phase 3 Procera top line readout of seralutinib in PAH. And, one of the things, Oppenheimer, it's one of their top plays of the year, which is significant because it's a binary play. And so for, a big institution to have that as their top play, and it could be a hit or miss. It reminds me of Resolute that I just talked about that failed their phase 3 study. That was a top Guggenheimer pick. And that ended up not doing well. Goss, all it's done here, if you look at the chart, since the beginning of the year, actually in mid-January, it got as high as 280. And then it's tapered off since then. It's fallen significantly. And I think, that's in part because, the data is any day now. And so they could either hit and it flies, or they could not hit and it goes down. But when you look at the cash position, they have $124 million in cash, so 10 and a half months of cash. And, but they've got a lot of shares outstanding. They've got 231 million shares outstanding, 181 million in the float. In terms of a run up or catalyst play, I think once they ventured into February, that ship kind of sailed. So we saw their high around $3. And, obviously toward the latter part of 2025, that stock was trading, in the mid 150s to $2. So it had a nice run during that time. But that's a play where, again, you look at the cash position, you saw that it did what it was supposed to do through most of January. And then obviously people knew the data was going to be in February, and it's pulled back because you have a lot of retail investors that don't want to hold. So that's a catalyst moving forward. I don't own that one, but I am watching it because, again, I think it's testing the theory that, playing into and up to these catalysts is more important necessarily than holding through a catalyst, especially when it's a binary event. Let's look at PEPG, Paul Gary. That's PepGen. And they've got multiple ascending dose data in the first quarter that offers upside, skewed risk reward. It's followed by Stiefel. And, when they had their SAD data, their single ascending dose data in early 4Q, the stock ran significantly. I mean, from October to December, it ran from 114 area to well over $6. So we've had quite the run. I know they're going to have data coming up here soon. We've seen that one push higher because it's multiple ascending dose data, and they've already had positive single ascending dose data. I could see where people would be enthusiastic about it, and even with the timeline they've just said first quarter, so they haven't really talked about if it's going to be at the end of excuse me, March, or where it's going to fall into. So if you look at their cash position, they have 20 months of cash. They have $133 million in cash. The market cap's $444 million. So, a lot of institutions are in this one, a lot of solid institutions. So it's really going to be interesting to see. They only have 40 million shares in the float, 68 million shares outstanding. So it's very tightly held amongst institutions. And so that's one that I like. I have a small position in that. I've watched it close to the data. I like how it's trading. But am I going big on this? No, I'm just going with the fact that they've had, they've had solid data early in the latter part of 2025, and that, I'm thinking that they're going to have solid data coming up here soon. Let's look at Milestone, MIST. Milestone, they've already got a product approved. They've got Cardamist, which is Intrapamil, and for the heart. And so right now they've got 67 million in cash. They've got 20 months of cash. And right now, this is just pretty much a cash play because we know that they're going to be introducing this product in March. So we're going to start to see revenue come in. They've already gone through the difficult portion, which happened in December, of getting their product approved through the FDA in mid-December. So now it's just a matter of them going on ahead and getting ready to launch the product. And I think because they're the first in this space, that, it's basically an earnings play. So people always ask me, do you want to, just invest in catalyst plays, or do you sometimes wait till products get approved and based on their cash position, take a position in that company? Well, yeah, this is one where I'm looking and I'm saying, hey, it's $1.70. They've got, a ton of cash, and they're going to be launching a product here shortly. So I think, this is one where I bought some shares today around 170. And did I get a huge position? No. I got about 5,000 shares, but they've got 70 million shares in the float, 85 million shares outstanding. I mean, I can see it once they launch getting to, $2.50, $3. And, from this price, that's a significant improvement. That's, well over 40%, 35, 40%. So, I like where they're at. I definitely do. Let's go on to the next one. The next one is, and thanks everyone for, I'm just getting over a cold, so I've got an itchy throat. I've been drinking water. And so, there might be a few times where I mute and have a good cough. But let's go to ALDX, Apple, Larry, David, X-Ray. And ALDX is a PDUFA play. They had a 3-month extension. So, December 16th of 2025, the FDA said, hey, we need to set back. You did a new clinical trial. We're going to give you an extension. But, this reminds me a lot of Outlook Therapeutics. And, Outlook Therapeutics had, a 2-month window in terms of approval where they got acceptance in December, and then February came and the FDA said, hey, you need a new clinical study. This is trading like that is going to happen. If you look at what it did from the beginning of 2026 through mid-January, it went from about $4.20 to $5.60. And we've seen over the past, 3 or 4 trading days, it come down significantly from that $5 range down to $4.95. It's going to be an interesting play. It's going to be interesting to keep an eye on it. But I think there's thought that the FDA wants a new clinical trial. Even though they did a clinical trial specifically based on what the FDA asked for, they didn't consult with the FDA. And this new FDA is, especially when it comes to efficacy, wants to be on board with clinical endpoints that are being done with studies. And we saw them, even though they had, they got this accelerated, 2-month review. We saw them give a CRL to Outlook Therapeutics, OTLK, and I think ADLX will be the same way. So I'm watching that. It's a PDUFA play. Again, PDUFA plays are good when you're not dealing with efficacy sometimes in brand new clinical studies. It used to be where you get an extension and people would think, oh, that's a great thing because they would have just given them a CRL. And then you saw OTLK and you saw them get hammered and it wasn't a good thing. So I'm just watching that one. NRSN, Nancy, Robert, Sarah, Nancy. They had Alzheimer's clinical and biomarker outcomes data today. And they closed yesterday at $1. The data, and so what you saw was the company most of the day hover around a loss of 5 cents, and then toward the end it closed at 85 cents. But if they didn't have such a strong cash position, which is not an extremely strong cash position, but they weren't on fumes like GTBP and FBLG that I mentioned earlier. But this is a company that had, a lot of people were saying, hey, I'm going to invest in it because it's data that deals with pharmacokinetics, bioclinical outcomes. They didn't have a huge cash position, but they didn't get crushed today. And I think this also speaks to the risk reward. The company had $4 million in cash, which isn't a lot. I don't see what their cash burn is. But it was, a lot of people invested in this. I was watching it. I really didn't. I thought it was interesting that it's in the Alzheimer's space because obviously if the data was more positive around their clinical biomarkers, that I think it would have flown. But it's also hard to say without them having much cash in the bank. And going with the previous examples that I gave earlier, a lot of times these companies, regardless of the catalyst, if there's not enough cash to get through the catalyst, if it's negative, even though this was a phase 1, it can oftentimes hinder the ability of that stock to appreciate based on good data. Let's look at ALZN. Alzamend, they have top-line data in the first quarter. This is data at the end of the first quarter, so ALZN. And, it's head-to-head studies in AL001 versus a marketed lithium carbonate product. And, if you look at what they've done from from kind of mid-January where they hit a high of 240, they've gone down to about the 190 range. I'm not trading this one because it's talking about first quarter. It's not saying I thought I'd read something where it said end of first quarter, but I'm not positive on that, and so I don't own this one. Again, it's Q1 data. They have $3 million in cash position, which is 7 months of cash because they have a low burn rate of 400,000, but it's still not very much cash, and so it doesn't. if they do well with this data, the stock could take off to $3 and above, and then I could see the company immediately raising cash. But if their data is not positive, with them only having $3 million in cash, I don't see that there being much upside at all. I mean, I mean the stock could go completely opposite way for us. So I'm just watching that one, but that's a catalyst. Anytime you're dealing with Alzheimer's data, whether it's phase 1, phase 2, or phase 3, investors want to know, because those are oftentimes some of the biggest movers in terms of biotechs with data around Alzheimer's. Let's look at PCSA. Paul, Charlie, Sam, Adam. If you look at this one, this company's done a reverse split. They did a reverse split recently, but last year they showed some data in 16 patients in breast cancer. They looked at capecitabine. It was phase 2 studies, and it was looking at the tolerability of capecitabine with their drug technology, and their drug technology was shown to their NGC was shown to have a positive effect on patients in terms of lowering their the hand-foot toxicity associated with capecitabine. So I'm looking at this one, and I'm also seeing that the company literally has 1 month left of cash. The data is supposed to happen at the end of the first quarter. I believe the data is going to be positive because the first 16 patients were positive, and they're going to give an update on 18 patients. I believe it's going to be the same area and the same, data that they share. But when you look at the cash, it's extremely low. So this is one where if the data wasn't good, in that low cash position, they're going to have to raise in front of the data or before the data. And, again, I've talked about that situation before. That would not be good for the company. But they do have data upcoming in March. They've had previous data that they showed in the first 16 patients, which allowed the stock to run significantly. I think it ran to $4 or $5, and then and that was post split, and then it's pulled back since then. So, but keep that in mind. It's a breast cancer catalyst. It's dealing with capecitabine, which is one of the most commonly used therapies. Because it's basically a substitution of 5-FU leucovorin, which, or if not leucovorin, but 5-FU, which is oftentimes a base in a lot of these chemotherapy regimens and different toxicities. But with this specific NGC, it's NGC cap, it's for breast cancer. So keep that in mind. Look at Rocket, RCKT. So RCKT, they've got a PDUFA that was extended. They have, let's see, they've got, they actually PDUFA date accepted after resubmission on, so they have they had a CRL issued on June 28th of 2024. And, they had a resubmission. So they're expecting a March 28th PDUFA date. And so if you look at where they're at in terms of their cash position, it's pretty strong, actually. They've got $143 million in cash. They've got a cash burn of 17 months, which is significant. And because they are they've had a CRL already, and they've addressed those concerns around their CRL, which is a lot around manufacturing and so forth, because their data was positive. This puts them in a good space. Their primary and their secondary endpoints were met for Cresladit, which was well tolerated. And if Rocket gets approval, then not only do you have this solid cash position, and they're trading close to their 52-week low of 219 heading into this March 28th catalyst, the 52-week high is $11. So if you think somewhere in between, they're closer to the 52-week low than they are their high of $11. That gives a good trading a good trading range for this to trade into the catalyst of March 28th. So we could see $4 plus, moving forward as we trade into this catalyst with investor confidence in the fact that it could get approved because they've already had a prior CRL. And there's no efficacy related issues. It has to do with with their manufacturing. So keep that in mind. Also, if they get approved, then people are going to look at another 150 million that they could sell their rare pediatric disease priority review voucher, because they're going to be eligible to have a voucher on approval, and that's going to be significant. It's just going to add already to the market cap of a company that's 370 million. You give them a voucher and they can sell it for 150 million, then that's going to be significant for the company. So that's Rocket. So that's a PDUFA play that I like. I've got a small position. I may start to add to it. And I like the trading range. You've got a month, but you got about 6 weeks to trade into that. And if you hold, that's on you as well. That's the risk you take, but it isn't their first time to the rodeo. They've already been smacked by the FDA with the CRL. And most of the times when companies have these CRLs, especially if they've had multiple, but particularly if they have CRLs that aren't specifically related to efficacy, those companies tend to do better. And also, we're looking at risk reward. We're taking a good look at the cash, and we're seeing that again. 150 million almost in cash. That's pretty significant. So RCKT. Next one, UNCY. UNCY is my favorite play. It's my biggest holding. That's UNCY Unicisive. It's the top play for the year for H.C. Wainwright. They've got 40 million in cash. As John had pointed to earlier, that the the new hedge fund filings just came out, and Biopharm Catalyst has all of those. So if we can see the page where they have it, that's outstanding, because it's a good way for you to see the new filings that have taken place and who owns the stock. For this fourth quarter of 2025, we just saw a filing come out yesterday that Not Perceptive RA Capital Management and Peter Kulczynski took a 9.99% position in Unicisive. And that's solid. That's an outstanding position, especially going into the fact that they have a PDUFA on June 29th. And it's a significantly de-risked NDA, because they had one issue with with their CRL, and it didn't have to do with them. It had to do with their third-party manufacturer, and them FDA working with them and them making sure that they were up to compliance. So UNCY, from their notes, said that they were looking at that company that had caused them to get a CRL, and looking at another company. And the FDA basically told them, stick with a company that's already gotten the CRL that we gave to, because they're closer to being in compliance, and we expect that they will be in compliance by the time at PDUFA. So this one, it's my favorite play of the year. The phosphatemia market is absolutely huge. They have oxylanthanum carbonate. Again, they have a standard review, so it's the June 29th PDUFA date. They've already had a CRL. The NDA is viewed as highly de-risked, as the FDA previously reviewed the package and raised no concerns regarding clinical data. And while the complete response letter was issued solely due to CMC-related issues of the third-party manufacturing facility, nothing to do with efficacy. So there's a lot of smart money in this play. And, the fact that you're only able to take that you're only going to be able to take 3 pills a day versus a lot of the first line therapies where you're taking 9 pills a day is going to enhance patient compliance, quality of life. And also, it's important to note that after approval on June 29th, after that decision's made, they're going to be in line for TDAPA, which is making sure that their drug is accessible to everybody, and that it's paid for on a national level, which they're one of the few companies that is going to be in that realm for being able to tap into TDAPA. So obviously everything is timed perfectly with the approval and then TDAPA being in July, but it gives them a strong headway into PDUFA. So I like that one. That UNCY is, again, it's the number one pick for H.C. Wainwright. That's been discussed that they're a potential M&A target because the drug addresses this critical unmet need in 450,000 U.S. hypophosphatemia patients by replacing the current 9 to 15 daily pill burden with a best-in-class 3-pill regimen of baby aspirin, um, size swallowable tablets. A lot of these tablets are horse-sized pills, but it's a very small capsule I've seen. So anyway, that UNCY, be looking for that in June 29th. That's my favorite play for the first half of 2026. Let's look at Vistagen, VTGN. So Vistagen had the Palisade 3 that just took place. They have a ton of institutions in this one OrbiMed was the biggest holder, was definitely one of the biggest holders. Um, and that stock, went from $5-6 down to 50 cents after their first failed trial in December. And so here's where we're at now. They just had their earnings on the 12th of February. It's a 52-cent stock, right? They have the market cap's only 20 million. They have 53 million in cash. So they have 9 months of cash. They have the Palisade 4, which is supposed to be in the first half of the year. The expectation is June. But we'll know because in their presentation, they said that they're going to alert their investors when the last patient completes enrollment. So obviously it's when the last patient completes enrollment to when the data is out, and that's usually 6 to 8 weeks. So again, if that last patient enrolls in April 1st, then you know that the data is 6 to 8 weeks out, so it's going to be mid-May. So this Palisade 4, for the acute treatment of social anxiety disorder, they're looking at the totality of the data because their Palisade 2 had good data. Palisade 3 didn't, but the Palisade 4, they made some adjustments in some of the strategic areas of their clinical study to help increase the probability that the data meets clinical endpoints. But as a trader, what you should know is that right now it's trading at 52 cents. The 52-week low is 43 cents, right? 52-week high is $5.14. So I could see that running in anticipation of this phase 3 data because the marketplace is massive. It could run to over $1. So 52 cents, I think, is a fair entry point to where it plans on going. Again, like I said before, the company's going to do a press release on the last patient enrolled. And you want to be in ahead of that because when investors see that, they're going to time it out 6 to 8 weeks for data, and it could run based on that. But if you're in now at 52 cents, you're not missing the run, or you wouldn't miss the run. So that's one to look at. I do like that one. I did buy a position in that one today. And again, I love the fact that the debt to equity is extremely low. They've got a lot of smart money in here. OrbiMed is the biggest shareholder. They've only got 27 million in the float, 39 million shares outstanding. Again, market cap is 20 million and they've got 52 million in cash. So they're trading, well below book value. So VTGN, I like that. Their catalyst is first half of the year, I would say June. And but we'll know once they share when the last patient's enrolled. The next one is GUTS, Guts. That's Fractal Health. And I did want to say that, again, the tool on Biopharm Catalyst is excellent in terms of being able to see the cash position and being able to see the catalyst all in one area. And that, as a trader, that's what you want. You want to be able to see all that information in one area. So that's important. So let's look at Guts. Guts, had data, in January that, market did not take well to. I thought the data was good data, but it's all in how it's interpreted. And the market has the final word. But I think what's more important now is that, Revita has FDA breakthrough device designation for their weight maintenance in patients who discontinue GLP-1 therapies. So that breakthrough device designation gives them the opportunity to have more discussion with the FDA around what they need to do for the clinical trials to move forward. And so based on ongoing interactions with the US FDA and the safety and tolerability data observed to date, Fractal Health has requested FDA feedback on potentially reclassifying their Revita under the de novo pathway rather than a PMA, pre-market authorization, which would get them to the market faster. And that is pretty significant when you think about it. So the de novo pathway is intended for novel medical devices with low to moderate risk profiles and may enable a more efficient risk-based regulatory process, which is better for them moving forward. So, why is that important for investors? Well, it's important for investors because the company expects FDA feedback regarding potential use for the de novo pathway in the second quarter, so April, May, or June. So if they hear back and the FDA gives them the green light, the de novo pathway is a lot easier to get approved. And we're talking about what it's used for. It's used for maintenance, weight maintenance, and patients who discontinue GLP-1 therapies. That is a massive market. And so I think it's really important moving forward that is important to watch. It's important to see you know, um, you know, how it's being looked at, and if they get good positive feedback from the FDA, it's significant. Again, 52-week low is 38 cents. They're at 42 cents right now. The market cap is 57 million. They've got 59 million in cash. They've got 8 months to cash. They have data in the third quarter. Um, well, actually, no, they have phase 3 data of the Remain study. They have interim data in quarter number 2. So they're expecting data in quarter number 2, which is significant. It's which, as you can see, it's 6-month endpoint data. Their Remain 1. They're looking to show 6-point endpoint data with no serious AEs, and so I think the midpoint cohort randomized data is in the third quarter, and then the FDA meeting and 1-year cohort data is expected. And the FDA meeting is the de novo data the decision I talked about. And then they're expecting that 1-year cohort data. But you look at where it's at now. Again, I like $59 million in cash with a 57 million market cap, and it's in the GLP-1 space. So there's a lot of people that waited on this because obviously it was in the mid twos, and it got hit, and then it went down to 40 cents. But again, it's right near the 52-week low. So if you're looking at a bottom play, where the FDA could give them flexibility on a de novo pathway, that would send this back over $1 because, again, as John talked about it too in the beginning, and I touched upon, the GLP-1 space was hot last year. And while there's a lot of discussion about, which companies are going to be the key players and stuff, it's still at top of line for investors. So let's go to Palisade Bio, ticker symbol PALI. So they're expecting data in the first quarter, the end of the first quarter. And it's using Pali 2108 to treat fibrostenotic Crohn's disease. So that's a big space. Look at this company. It's again, they have $160 million in cash for a mid cap company. That's huge. They've got 95 million shares in the float, 149 million outstanding. Again, 133 months to cash. That's crazy because their cash burn rate is extremely low at 1.1 million per month. So again, they've got data in the first quarter. I own that one. I like it. There's a lot of smart money in it, and I really like it. Look at Ovid, ticker symbol OVID. They've got phase 1. OVID has phase 1 data for OV329 in the first quarter. And this is another one that is a mid cap, small cap play. Tons of cash. 96 million shares in the float, 130 million shares outstanding. Market cap is 188 million, but they've got 180 million in cash. So they've got 42 months of cash, which 3.5 years. That's pretty substantial. But again, this is what Ovid is owned by a lot of big money, and their OV329 is a big platform play for them. So I like Ovid. I like them longer term this year. I own the company, shares of the company, and their phase 1 trial top line data confirmed OV329 penetrates the brain, engages the target, and achieves biological modulation as expected of GABA levels. That was on October 3rd. So, we're going to see, updated data from OV329. So I think I'm watching that one, and I own it as well. And that's more of a long-term play for me because I don't just see it as a drug play. I see it as a platform play. Okay, so look at GRCE. GRCE has a PDUFA date on April 23rd for GTX 104 in the treatment of patients with aneurysmal subarachnoid hemorrhage. They have a comprehensive data package that was supported by positive results from a phase 3 data for GTX 104. So the thing I would make sure of here, and I have emailed the company, I want to know what the manufacturing is like if they've already had their site inspected and if it passed inspection. If that's the case, I'm definitely going to look to hold this through. But in the meantime, it's a good run-up play because the data, the PDUFA is on April 23rd. You've got a company with not a ton of cash. They've got 22 million in cash. The market cap's 53 million. But look at the float: 10 million shares in the float, 13 million shares outstanding. They've got 23 months of cash, so almost 2 years of cash, very low burn rate, and a lot of smart money in this. Adar Capital Management, which is David Heffenberger, Harvard MBA. I mean, he's brilliant, and I follow his plays. Obviously, I followed QNCX, didn't do well on that one, but that was one where I just shouldn't have held into that one. And I tried to get out that day, but obviously, because I saw it going from $3 down to $2.70, but you couldn't, not when they release data midday, which most companies don't do. But all that to say, the GTX 104 has the Strive on data, or has it's for what I mentioned, the indication, aneurysmal subarachnoid hemorrhage. And that's the 23rd. So keep that in mind. I don't own that, but I'm going to buy that, and that's one I'm going to play into the run up. I think you can get to $5, which is 25% from here. And again, it's all about base hits, not home runs, base hits in this market. Follow the smart money. Let's look at RYTM. They've got, I'm just going to touch briefly upon this. They've got regulatory decision on March 20th. And so they've got set melanotide, and the regulatory decision is based on their Transcend study, and they've got priority review. They've also got breakthrough designation. So that stock is typically higher than what I trade, but it's a PDUFA play, and I want to make people aware of it. So so that's why I followed that. TVTX. Many firms continue to hold a positive bias on Filspari setup ahead of their PDUFA for FSGS. So they're right now, they're $27.84 a share, somewhere around there. They've got 277 million in cash. They've got a pretty big marketplace or market cap, excuse me. And it's another one where you have a company that had an extension, and so I think they're gonna pull through and they're gonna get approval. $28 is pretty high for a lot of these biotechs that I play, but I still like it. If you're looking for a play to get in that has an extension, has dotted all the I's, crossed the T's, TVTX is one that's owned by a lot of institutions, and they've got a healthy cash position. So watching that one. Let's look at CTMX. That's Cytomics Therapeutics. They've got phase 1 expansion data for first quarter, 73 patients enrolled as of August 2025, but they're going to have 100 patients that they're going to update in Q1. And when they did this back in August, the data was positive, and the stock price did really well. So again, they're going to have an update on 100 patients. Their goals, for their phase 1 expansion data update or evaluate efficacy profile in a larger sample size, and to characterize their adverse event profile in a larger number of patients, including adverse events management strategies that have been utilized to date. So, this company has a lot of institutions, strong institutions, Perceptive, RA Capital, a lot of the KOLs talk about the strong setup into the first quarter for this CX 2051, which investors should anchor on three numbers for the upcoming CX 2051 dataset and colorectal cancer, and that's overall response rate, progression-free survival, and then they want to see a grade 3 diarrhea of less than 5%. In colorectal cancer patients, that would be outstanding. So if they're able to update that 73 patients to 100 patients and have the same results that they had back, in August, I think the stock's going to run nicely, and it's held pretty well so far. They've got $120 million in cash. Um, Again, a lot of institutions, they've got 23 months of cash. Again, I can't stress how important that cash position is, because it allows investors to understand what the company is dealing with on a long-term basis. And it allows them to value their pipeline even further if a product doesn't work out, if they have other products in line that they can bring to market based on their cash position. If there's no cash, their pipeline doesn't matter because they can't bring those products to market. So in biotech, especially as we've seen year to year, and 2026 is going to be no different, cash is king. So keep an eye on that one. Got a few more and then we'll be good. CABA, CABA. So CABA has interim data in the first half of 2026, and then they have initial data in mid 2026. CABA's $3.10 right now. They've got $105 million in cash. They've got about nine months of cash. Market cap is $300 million. If you look at where their stock was in February, it was in the low $2 range. And I would say late January it was in the low $2 range. So we've had a nice run here from the early part of February till now, which has been only a few weeks, upwards of 310. And so obviously this is what I like about stocks that can run. And this stock is followed by Joshua Schimmer, who I believe is with Cowen, but he's a solid analyst and he does his due diligence on companies. And the investor focus right now, as I mentioned before, is on CABA 201, which is a CD19 auto CAR T for myositis and lupus. And so that is what we're going to see data for moving forward. His conviction level on that program is extremely high. I own some of CABA in the $2 range. And so, I've been watching this one for a while, but again, they have a strong cash position, and they have upcoming catalyst here in the first half of 2026. And I think that could be around ASCO, since we're talking about CD19 drugs. So, I think that's one to watch. Let's see, Achieve, ACHV. ACHV has an approval date for cystinicline, and that is cystinicline is for smoking and nicotine addiction cessation in the U.S. and internationally. That stock is $4 right now, but they've got $30 million in cash. Market cap's $222 million, but that's a catalyst play. So that's a June 20th catalyst play to keep in mind when you're looking at, like, I own UNCY, as I mentioned before. The other June PDUFA play is this one, and so I I can see this one getting upwards of $5.56. Solid catalyst play with a good cash position of $30 million. Silo, SILO. If you look at Silo, I like that one. It's 29 cents. They've got data in early 2026, so March. They're expecting an IND application, and then they're also expecting toxicokinetic data in the first quarter. So the reason that's important, company only has $4.5 million in cash, but their burn rate is extremely low. So they have almost 14 months of cash. The 52-week low is 27 cents. 52-week high is $1.52. So when you have 14 months of cash, you've got a catalyst that's a month away. You have less worry about them diluting or having to raise into this event. That's key. So if they come out with solid toxicokinetic data and then also they announce IND plans, that company could double off of that catalyst alone. Again, 16 million shares outstanding, only 10 million in the float. Market cap is 4.6 million. They have 4.5 million in cash. So they're trading right at cash. And then their SPC 15 drug is what we're looking at. So when people ask me about catalysts and like, hey, do you know of a micro cap catalyst? Well, this is a micro cap catalyst right here. And so that's one to watch. And that would be in March. And then we've got two more. We've got Invivid, which is $1.63, IVVD, Indian Victor David, 200 million in cash. Market cap's 380 million. They're focused on the development and commercialization of antibody-based solutions for infectious diseases, and basically this COVID pill that they have. That data for that is going to be in mid-year, and there is some smart money in this one. I mean, extremely smart money. And so I've got a really small position in IVVD, but I mean, look, $200 million in cash right now. They're definitely well financed. You've seen since the beginning of 2026, they've gone from 250 down to 160. So, if it pops back up to 250 into that May-June catalyst, they said mid-year, so probably June. Don't have a specific time frame. They could announce it at a meeting. It's hard to know. But looking where it's dropped since the beginning of the year in early January from 260 down to 160, as it gets closer to that catalyst, it could easily catapult back up to 260. And so that's one to watch with their solid cash position and strong institutional holdings. Look at PMN, ticker symbol PMN. That's Promise Neurosciences, and they're focused on Alzheimer's. So here's the thing. When I was talking about this back in November, it was 39 cents. And they were going to do a reverse split. And they did do a reverse split. And the stock ended up reverse splitting and being $6 or $7 a share. And it only had 1 million shares in the float. Well, since then, it still has 1 million shares in the float. And it has 2 million shares outstanding. But what they did about a week or so ago was they did a huge, like, $175, $200 million financing. And so when you look at this company, the market cap is 35 million, but they have 175 million in cash. I mean, because of the what just happened. So we've seen this company just shoot up from $7 to $16 a share. The market cap is still only 35 million, but it's trading at $16 a share. Why is that? Well, there's a drug called PM310, which is almost 90% enrolled. So they're going to do, once it's fully enrolled, which will probably be March, they're going to talk about when the data is going to be out. And I think it's going to run off of that. Again, 1 million shares in the float, 175 million cash. They have 6-month data, which is on track for the second quarter. And that's interim data. And, basically, it's PM310, has a differentiated mechanism of action, selectively targeting toxic amyloid beta oligomers, which are the primary drivers of Alzheimer's disease. And so they're not looking at tau that a lot of these other Alzheimer's products have done in the past. They're, the trial focuses on a comprehensive panel of biomarkers, which has been shown to correlate directly with clinical outcomes and will serve as a key indicator of target engagement. So as the significant catalysts are approaching with interim data, biomarker data expected in mid-2026 and final top-line year in 2026, management has talked about there's strong business development interest from large pharmaceutical companies due to their unique mechanism of action and promising data. So PMN, I know it's $16 a share, but at a million float and 2 million outstanding and a huge cash position of institutional investors going big in this company, it's one to look at. And it's yeah, I don't own any right now, but I'm gonna wait for a pullback. Maybe I can get in the 15s and get, a small position, because if this hits, it's phase one data. And if it hits in the June timeframe, that one's going to be a 50, 60, $70 stock. So keep that in mind. And then that's pretty much it. I know I covered a lot of stocks. But again, my main focus was to talk about, mistakes that I had made. It's easy to talk about the stocks that do well, because sometimes the stocks that do well, you don't necessarily always learn from them. But the stocks that don't do well, you do learn from them, because you say, how did I mess that up? And as I mentioned early on, it's extremely important that you're using the tool that allows you to go in and see what the cash position is and correlate that with the catalyst. And I think that'll increase your reward risk ratio rather than increasing the risk to reward ratio. And that's promising for all investors moving forward. So, look at that. And as also we talked about that tool of hedge funds, which just came out yesterday. Make sure you go onto your Biopharm Catalyst and you're looking at which institutions took a look at the stocks that you're in. It's really important, because that's how you get a gauge of the sentiment and the insider holdings that are occurring, because oftentimes these folks are talking with management and they're getting a good sense of what these particular companies are doing and how they're behaving, and they invest based off that. So that's it for now.
Thank you so much, Sheff. Obviously, ton of information there, as always, and we really appreciate your insights and everything that you just went through. I think there's so much for folks to take away from on this, and so I would encourage, maybe watch this episode a couple times. Make sure you go back and listen to what Sheff's some of the recommendations that Sheff had made, and some of the, again, to your point, Sheff, some of the mistakes as well. I mean, I definitely think it's really important, particularly in an industry and a sector as a whole that has so many variables, right? We've said it a bunch of times. If it was as simple as, putting money into a stock, and then if the data was positive, then you're good to go. Like, you know what I mean? It's not always that simple, right? And most of the time it's not that simple, right? So there's, there's market expectations, there's, cash runway, there's float metrics, there's partnerships, there's, you mentioned about manufacturing sites, whether those were vetted properly. There's a lot of variables that go into trading in biotech, and for various reasons, obviously price targets, when you got in, when you were looking to get out, right? A whole bunch of things that go into it. And I think it's important to take a look at, to your point, when things didn't work out, what was the reason for that, so you can make more educated decisions moving forward.
Yes. You're right. And just tightening up your strategy, because the
Yeah.
market, you have to adapt your strategy to what the market
Yeah.
is willing to give you. And cash positions are so important these days, as companies are looking to, tailor down and make sure that they're focusing on growth opportunities.
Yeah, absolutely. Well, as always, we appreciate your time, Sheff, and we appreciate everyone's time who takes the time to listen to our podcast. As always, make sure that you, if you like our content, subscribe to the channel. Check out our website if you've never checked it out before, to get a lot more information. Like the videos and then comment on them. Like I said, we definitely check our comment section. We answer questions. If you have specific questions about the episode or things you want to hear, we love that kind of stuff. So please do that. And we will see everyone next month for another episode of Biotech Bulls and Breakthroughs. Thanks again, Sheff.
Thank you. Appreciate it, everyone. Take care.
Yeah. Take care.